Once again, thanks everybody for attending. Welcome everyone to our webinar, Understanding Your Retirement Benefits. I'm Casey Gibb, Managing Director of Financial Planning at H&A. With me this evening are two of our financial advisors, Christina Hapanowicz, a CFP who sits on both our financial planning and investment committees, and also Bobby Hapanowicz, who helps lead our investment committee. So again, just thanks everybody for attending. For over 2 decades, we at H&A have been delivering worry-free retirement for people retiring from large companies. It's what we excel at. Christina, do you want to expand on that?
Yes, thank you, Casey, and welcome again, everybody. Thank you very much for attending today. So we are covering a guide to the retirement plans that you are most likely benefiting from and participating in as someone who works for a large company or corporation. Now, before we get started, I see that some of you are joining us by phone. So just so you're aware, we will send out a recording of this webinar to everyone who attended today. And that way, especially for those of you joining by phone, if you'd like to watch it back with the slideshow that we have for you to present, you're able to do that. So as I was mentioning, we're going to get into a high-level guide of these retirement benefits and what they mean to you and how they should, most importantly, work within your total financial plan and retirement plan as well. Something we want to stress, though, is that H&A is not affiliated with any specific company or organization. We are not affiliated with any specific company or organization. So what that means, that's in our eyes actually a good thing. What that means is that we're able to provide third-party and conflict-free advice to the individuals that we work with. That being said, we are going to get into some of these retirement benefits. And also what we're going to do is cover just a couple of additional topics that we think you should really be focusing on when you are doing any sort of retirement planning or financial planning. So let's get into it. Bobby, do you want to talk about what a 401k savings plan is and the meaning behind it?
Absolutely. Thanks, Chris. So the 401k plan is designed essentially to provide you with an opportunity to save for retirement. And for a couple of reasons, we believe this is the best retirement savings vehicle available to you today. And the first of those is the favorable tax treatment that contributions receive. So contributions come in the form, of course, of a salary deferral. You're contributing a little bit out of each paycheck. And those salary deferrals can be pre-tax or after-tax in nature, or in some cases, they can be a combination of the two. And so this is the IRS's way of incentivizing you to save for retirement. Mm-hmm. And the second reason that we really like 401ks is that employers will oftentimes make a matching contribution of up to a certain portion of your salary deferral. And this is a component that is completely unique to 401ks compared to other self-funded retirement accounts such as IRAs. We really encourage folks to look at this like an extension of your paycheck. So if your company is offering a 3% match on your contributions, that's a bonus. That's free money. And for that reason, we think it's really important to take advantage of it. But circling back again, the combination of these two traits, the favorable tax treatment, the employer match, are why we believe the 401k is the best retirement savings vehicle out there today. And there are some contribution limits that you should be aware of. They're listed up there on the screen. But with those in mind, we still believe the 401k for many folks should be the centerpiece of their retirement savings.
Absolutely.
Right, Bobby. Yeah, Bobby, it's the vesting schedule that determines when the company matching contributions will belong to you, the participant. So you'll really want to contact your HR department or read what's called the summary plan description to find out what that schedule is. So the range of schedules are immediate vesting to possibly over 5 to 7 years. Mm-hmm. Understand your vesting schedule and how it pertains to you and when you'll receive those benefits if you were to leave the company. Yep. Final bullet point here is retirement accounts have beneficiary designations. So you want to make sure each year that these beneficiary designations are up to date and current. Due to marriage, divorce, birth of a child, etc., things could change. So we recommend annually updating and checking your beneficiary designations.
Yeah, and that's not just for a 401k, right? That's for any retirement plan that you might have. Check those beneficiaries.
Retirement account, 403b, 401k, IRA accounts.
Absolutely, absolutely. Mm-hmm. Let's move on within 401ks. Before I do that, though, I did forget to mention we're going to take some questions at the end. So throughout this presentation, if you do have questions that come up, please do feel free to use the Q&A box to submit your question, and we will take those at the end. Now, with 401k savings plans, one of the main components that they are known for is that the responsibility of investing and maintaining those investments and that asset allocation and the rebalancing that should happen within your portfolio, that responsibility lies on you as the participant who is contributing to this plan. So, there can be a lot of options available to you. There usually are. And one of the options we wanted to make sure that we cover today are target date funds. So, target date funds are a very popular investment option within 401k plans. You will find them in the overwhelming majority of 401k plans offered out there by different employers. They are essentially a fund of funds. So when you think about investing, you think about proper diversification, you think about proper asset allocation between stocks and bonds, and also, a more detailed diversification and allocation within stocks and bonds. And you also think about rebalancing as well. Those are just some of the many components that you have to think about maintaining your investments. And it can be a little time consuming at times. So target date funds essentially do all of that work for you, and they adjust the asset allocation between stocks and bonds to the appropriate amounts as you get closer and closer to your goal retirement year. So they essentially are designed to simplify that investment process. We think that for most people, this is typically a very great option for you when you are accumulating your wealth and, saving a bunch of money into your 401k over that long period of time. Now, that being said, that's not the only investment option available to you. So Casey, do you want to talk about the other options available to someone participating in a 401k?
Sure. You're right. Most 401ks have additional investment options such as stock funds, bond funds, money market accounts, stable value funds. So with this wide selection of funds, it's possible to build a diversified portfolio suitable to your risk tolerance, investment objectives, and time frame.
Mm-hmm.
Now, you could use what Chris was just talking about, the target date fund as your core holding, and then add to it these additional options to build an even more diversified portfolio.
Yeah. We really recommend that you work with your advisor when you're building this. And if you don't have a relationship with an advisor, every 401k plan out there offers some sort of advisory services and consultation. So take advantage of those resources to you. It can never hurt to get that second opinion. Even if you're pretty confident in your decision, still give that 401k services number a phone call, or call your advisor, have them look at it with you. And also, these allocations should be looked at probably once a year. Would you say, Casey, on average once a year?
I think once a year is very good.
Yeah.
Well, some folks like to do it more frequently, biannually, but once a year, perfect.
Yep, absolutely. Okay, so Bobby, let's talk about the distribution options available from a 401k. Do you want to get into this?
Absolutely. So when you are ready to make your retirement distribution, you have a couple of different options on how you can do that. The first option is to take a taxable distribution in which you are rolling your entire 401k lump sum value out into a taxable account. And doing so will trigger a 20% federal tax withholding. So you'll be paying a large amount of taxes upfront in the first year after you make that distribution. The alternative to that is to make a tax-deferred distribution by rolling over your 401k to an IRA or other eligible retirement account. And again, doing so will defer that tax liability. And in some cases, it could end up mitigating it too, because you won't be bumping yourself up into a higher tax bracket in that first tax year. And again, we do find that this second option of deferring your taxes and rolling into an IRA does work best for most people, again, for those tax considerations that we just discussed. So that is certainly one tax efficiency strategy that you can consider. There are many others when you are considering taking distributions from your retirement accounts or your retirement benefits from your employer. And this is certainly something we would encourage you to discuss with your advisor before taking any action.
Yeah. Whether you're working within your retirement account or if it's a non-retirement investment account as well, any sort of transaction or withdrawal is going to result in some sort of tax liability. So we really recommend talk with your advisor and even your CPA before making any of those big moves. If you're working with an advisor, then they'll always know to keep those tax consequences in mind before they make any moves within your account. But especially, a decision like how you are going to distribute your money from your 401k, you should absolutely consult your advisor and make sure that it's the best decision for you within your overall plan. Okay, so we talked about 401k plans. And let's talk about this next plan that we're going to cover, the cash balance plan. So you may remember me mentioning a couple minutes ago that with 401ks, the responsibility of investing and maintaining that account lies on you. Well, it's essentially the opposite thing for a cash balance plan. A cash balance plan is a pension benefit that you receive upon separation of service from the company you are working for. And with this all of the funding is done by your employer, and all of the responsibility of investing and maintaining those investments lies on your employer as well. So you essentially just receive that benefit upon retirement or upon separation of service. What your benefit will be upon separation of service depends on basically a formula that takes into account some components, and those components include, the number of years you worked for the company and what your title at the company is, among other things. What we recommend you do is use your online access to sign on every so often and get that updated pension benefit estimate. And that should be done, like I said, every so often, especially when you're doing any sort of retirement or financial planning. That way you can get the most up-to-date numbers as possible. Getting those updated estimates is also going to help you with that really important decision between a lump sum distribution or an annuity payment distribution. And we're actually going to get into that in a little more detail in this next slide. So Casey, do you want to talk about that?
Sure. Right, there are annuity options, both single life and joint life, and the lump sum option that you mentioned, Chris. But how you elect your pension payment is really a personal decision, and it's often determined by your personal financial plan. So you may want to elect the annuity option if you have a need or desire for a steady, guaranteed-like income. Or you may elect a lump sum if you desire to control the account yourself, both the investments as well as the timing of the income. So there are two ways to look at this. It's probably best in your financial plan to build out both scenarios. You'll come to the decision which is best for you. So it's all about planning and making that the final decision.
Yeah. There are certain factors that should be taken into consideration, but the factors that I would need to think about versus Casey or Bobby would need to think about are going to be different. It's a very personal thing and a personal decision to make. So again, not to sound like a broken record, but we do recommend working with your advisor on this. They will help you identify what those factors are that you need to think about when you're choosing between the lump sum and the annuity. And that way you're going to be able to move forward with that confidence that you've made the right choice. Something with a cash balance plan too, you can assign beneficiaries for this cash balance plan. So we recommend, just like the 401k and any other retirement plan, like we talked about earlier, check those beneficiaries at least annually. It's a really important aspect that we recommend you do. Okay, so we talked about 401k plans. We talked about cash balance plans. Those are the two main retirement plans we wanted to cover today. There are many more out there, but again, those are the main ones that you are likely participating in if you are working for a large company or corporation. We are first and foremost financial planners. So we like to look at a component of your wealth, not within itself, but as one piece of the overall puzzle of your financial plan and your game plan. So that being said, there were a couple additional things that we wanted to talk about today. Some items that we really think you should be considering on a continuous basis as you go about any sort of retirement or cash flow planning. And those three items are here on the screen, and I'm going to get started with Social Security. So Social Security, as planners, we identify Social Security as a guaranteed source of income. Now, nothing in life is ever guaranteed. However, when you are looking at Social Security versus other income sources, you can consider that a guaranteed source of income that is scheduled to inflate and grow year over year to keep up with inflation. You can take it as early as age 62. You can begin your benefit as late as age 70 or anywhere in between. The chart you're seeing right of the screen shows what your full retirement age is based off of the year you were born. So you can see that the later you were born, then the older your full retirement age is. Full retirement age, the significance of that is at that age, the benefit you receive represents your base benefit. So if you take your benefit any earlier than your full retirement age, for every year you do take it earlier, your benefit is projected to decrease by 8%. For every year you delay your benefit after your full retirement age, up to age 70, your benefit is projected to increase by 8%. So there is absolutely an incentive to delay taking your benefit to get that larger amount, but that doesn't always mean that delaying it to age 70 is the right age for you. So the right age for you to start your benefit is going to differ between you and your coworker or your neighbor. So again, we do recommend working with your advisor. There are some timing and optimization strategies you can probably take advantage of to make sure you're getting the most out of this benefit that you've been paying into for probably most of your life now. Okay, let's talk about health insurance.
Health insurance, a very important component of retirement planning, absolutely. The fact is some employers provide retiree health insurance, but most don't. In that case, the retiree would need to obtain individual coverage until 65. At 65, you can then apply for Medicare, but would probably still need to purchase additional coverage to supplement Medicare just because of the gaps of Medicare. So again, it's a very critical component of health, of retirement planning. We look at it very closely in our retirement planning that we do, and it can be very costly, and we try to mitigate those costs as much as we can.
Absolutely. Okay. How about life insurance?
Yeah, so life insurance. So life insurance is, of course, another very important consideration to make when you're considering retirement. There are many reasons why life insurance should be considered when putting together your retirement plan. Here listed are just a couple of those reasons. The first of which being that it can help protect the lifestyle of a surviving spouse. There are also some estate planning considerations and tax efficiency strategies that life insurance can help you implement. And of course, these are just a few out of the many reasons you might want to consider life insurance. And we do recommend that any decisions regarding this should be made holistically with the entire retirement plan in mind, rather than just as an individual decision in a vacuum. And again, this is something that your advisor should be able to help you with. But I'm sure many of our people who are listening right now, working at larger corporations, do have access to life insurance through their employer. And in some cases, it can even be possible to convert this insurance into an individual policy upon retirement. And this could act as your foundational policy from which you can build off of and to provide yourself more coverage if necessary. And again, that's something that you can consider as part of your retirement plan.
Mm-hmm. Yeah, your advisor will be able to help you determine if you have enough insurance, if you don't have enough insurance, or if you have just the right amount. And it goes beyond life and health, long-term care insurance, for example. So even if a question that you may have might not fall directly under the category of asset management or financial planning, still talk to your advisor about it. For example, H&A has 3 CFPs on staff. So we have studied and are trained to take all of these aspects into account and to be able to help the people that we work with in decisions that have to do with things other than investment management and financial planning. And this is part of financial planning. So please do work with your advisor. These are really important decisions.
Absolutely. So again, those are the 3 additional components to retirement planning that we wanted to discuss. And as Christina was mentioning, there are certainly way more than just 3 that should be considered. Christina mentioned long-term care. There are many others. Unfortunately, we just don't have enough time to review them all today. But these are, however, very important considerations. I just want to emphasize that again. And, many folks, when they think about their retirement planning, oftentimes they just think about it solely in terms of assets and savings. However, we really do believe that if you're able to think about retirement planning in broader terms, this is typically the best approach. And with that in mind, before we conclude, I just want to take another minute to talk about the importance of taking a comprehensive approach to your planning. It isn't just about the money you have saved, although that is a very important part of it. It's also about making sure the components of your plan complement each other and all work towards the same goals. And that's why, as you think about the decisions that we discussed today, we hope you make those decisions in terms of how they will affect the other plan components and how they will work towards the goals of the broader plan itself. Mm-hmm. And again, we have found that this type of disciplined planning approach can lead to the best chances of you accomplishing your goals in retirement.
Well put, Bobby. In fact, one of our favorite quotes at the company, our firm, is a well thought out and executed plan stands the test of time. As Bobby said, we're all about comprehensive and integrated planning approach. And we put planning first, helping you answer the question, am I on track for that worry-free retirement?
Mm-hmm. Absolutely. Okay, so we have a couple of questions that we can get into. Okay, the first one we have, can I contribute to my 401k and my IRA in the same year? Casey, do you want to take that one?
Yeah, good question. We hear that pretty frequently, and you definitely can contribute to both. This year, the maximum IRA contribution limit is $6,000 with an additional $1,000 if you're 50 and older. So by all means, don't ignore IRA contributions. It's an important part of your total retirement planning.
Yeah. Now, Casey, could that potentially mean, though, that the IRA contribution will not be deductible if you're doing that? Can you talk a little bit about that?
Right. If you're a plan participant or eligible to participate, your IRA contribution possibly may not be deductible based upon certain income thresholds. Mm-hmm. But maybe you might consider a Roth IRA, which is not deductible, but provides substantial long-term tax benefits.
Yeah. Yeah. So work with your advisor and your CPA on that. And they'll be able to help, figure out, if it's going to be deductible or not, the IRA contribution, and if it's a good idea. It most of the time is, though. It typically is. Okay. Next question. If I retire, or when I retire, do I have to take money out of my 401k right away? Bobby, you want to take that?
I can answer that one. The short answer to that is no, you don't have to take it out right away. If you are comfortable with the investment options and you like that continuity of staying in your employer's 401k, you can absolutely stay in there as long as you like, as long as you meet the plan's minimum account value, which is typically somewhat low. So in most cases, that shouldn't be a problem. We do see a lot of people roll their 401ks out into an IRA, as we discussed before, for a number of reasons, but one of those being for more investment options, the other one being that you have more flexibility in how you could take distributions and use those retirement assets that you've saved up. But again, if you are comfortable with your employer's 401k, you can absolutely stay in that 401k and use that.
Okay, great question. Okay, third question that we have here, can my Social Security benefit if I'm still working? Casey, you want to take that one?
Sure. Right, Carissa, you mentioned that you can start receiving Social Security as early as 62, and you can receive it even if you are still working. However, there could be a reduction of your benefit if you work and your wage income exceeds certain limits. For example, this year the reduction is $1 of benefits for every $2 you make over $18,000. Now that reduction goes away once you reach your full retirement age that you pointed out, Chris, previous slide. So absolutely, you can continue to work, but if it's before your full retirement age, just be careful of the benefit reduction.
Okay. All right. We have one more question. What is the annual limit for 401k and IRA contributions?
Bobby, you mentioned the 401k. Do you want to tackle that? Absolutely. Yeah. So the 401k contribution limit is $19,500 in the year 2020. The IRS does change those on a year-to-year basis. This year, the catch-up contribution is $6,500 as well if you are over the age of 50. So again, if you're over the age of 50, you can contribute up to $26,000 in your 401k. Mm-hmm. Right, and I mentioned the IRA contribution this year is $6,000
plus an additional $1,000 catch-up contribution if you're 50 or older.
Okay. I think we'll give just a couple more seconds for any other questions. But I think that's everyone. Okay, well, if you do think of any other questions, you can see our contact information at the bottom of the screen here and our phone number as well. As you can see, we are all still working from home to a certain extent these days, but you can still call us at the office and we are absolutely available there. So please don't hesitate to reach out if there are any questions that come to mind. And please do be on the lookout for additional webinar invites. We hope to host these as a series of webinars covering retirement benefits and other financial planning and personal finance topics. And we hope to see you at those future webinars. Thank you, everybody, for attending, and take care.